Welcome back to Smart Stock Sam, where today we are going deep on one of the most explosive AI infrastructure plays unfolding in the market right now. Meta just signed a deal that rewrote the AI supply chain map overnight, and the stock sitting dead center of that story is already making serious moves. Today, we are breaking down exactly how deep the contracted backlog goes, why Nvidia just made a $2 billion bet on this company, what the freshly revised analyst price targets are telling us, and whether this is a generational infrastructure buy or a very expensive ticket to a gigawatt-scale lottery. If you have been watching AI infrastructure plays and somehow missed this name, you are going to want every second of this breakdown. Let us get into it. To truly understand why the world's most sophisticated technology companies are lining up at this firm's door, we have to start with the wildest corporate reinvention story in recent memory. Because Nebius did not come out of a Silicon Valley incubator. It rose from the wreckage of a geopolitical earthquake. Nebius is the international successor to Yandex, once the most dominant search engine in Russia and widely regarded as the Google of Russia. After founder Arkady Volozh made the decision to fully divest all Russian assets following the invasion of Ukraine, he took the international cloud operations, stripped away every tie to the Russian business, rebranded the entire enterprise as Nebius, and re-headquartered the company in Amsterdam. A complete reinvention. But here is the critical distinction that separates Nebius from every generalist cloud provider in existence. They made a deliberate, surgical decision to never compete with Amazon or Google on storage buckets, virtual machines, or general web infrastructure. Instead, they coined a new category for themselves, the NeoCloud, a company engineered from the ground up for one purpose and one purpose alone: the crushing, GPU-dense, low-latency compute demand of large language model training and inference. Hyper-focused, vertically integrated, purpose-built for the AI era before most companies even knew what that meant. And that singular, almost obsessive focus is precisely what led to the agreement that sent shockwaves through the entire market. Meta just signed a 5-year capacity agreement with Nebius worth up to $27 billion. Let that number settle in for a moment. $27 billion, structured as $12 billion in fully guaranteed capacity commitments, with an additional $15 billion in expansion options sitting on top of that. For context, this is a 9-fold expansion of a relationship Meta had already tested and validated. This is not a pilot program. This is not a toe in the water. Meta is telling Nebius, build every rack you can possibly build, as fast as you can build it, and we will take all of it. That single contract creates revenue visibility stretching all the way to 2031. Now, ask yourself this. Would you have ever predicted that the company Meta trusted with the physical backbone of its artificial intelligence future would be a firm that completely restructured itself out of a geopolitical war fallout just a few years prior? Because this market never telegraphs its biggest moves in advance. But here is where the thesis gets even more compelling. Meta is not the only hyperscaler that has placed a major bet on this NeoCloud model. Microsoft was actually the first to validate the thesis at scale, signing a $19.4 billion contract for dedicated GPU capacity out of Nebius's facility in Vineland, New Jersey. When you stack the Meta commitment directly on top of the Microsoft agreement, Nebius now has approximately 70% of its projected future revenue locked in with two of the most technically sophisticated compute consumers on the entire planet. Analysts have started calling this the revenue moat, and for good reason. While legacy cloud providers are out there grinding for small business workloads and competing on commodity pricing, Nebius is selling entire AI factories directly to the Magnificent Seven. That is a completely different category of business. That is infrastructure operating at civilization scale, and the moat it creates around future revenue is unlike almost anything else in the public markets today. Now, here is the question that sophisticated investors are already wrestling with. How does a company actually secure enough chips to fulfill $46 billion in contracted backlog when the entire global technology industry is fighting tooth and nail over Nvidia supply? The answer arrived last week, and it changed the competitive landscape permanently. Nvidia made a $2 billion strategic equity investment in Nebius, acquiring an 8.3% stake in the company. This is not just a capital infusion and a press release. This is a supply chain guarantee dressed up as an investment. That equity position grants Nebius what insiders in the industry are now calling priority silicon status. Early access to Nvidia's next-generation Vera Rubin platform, the direct successor to Blackwell, arriving months ahead of any competitor. While the rest of the neo-cloud industry is sitting in an allocation queue, Nebius engineers are co-designing gigawatt-scale factory configurations alongside Nvidia's most senior technical teams. Is there another company in this entire sector that can say Jensen Huang's firm wrote them a $2 billion check and handed them a front-of-line pass to next-generation silicon? Because I cannot find one. And the physical infrastructure build-out required to match those ambitions is already moving at a pace that is genuinely hard to keep up with. Nebius just received approval for its largest United States project to date, a 1.2 gigawatt AI campus in Independence, Missouri. To put that scale in context, they are targeting 5 gigawatts of Nvidia-powered operational systems by 2030. And critically, Nebius is not operating like a traditional colocation provider renting out floor space. These are vertically integrated AI factories, facilities designed from the foundation up with custom cooling architectures and dedicated power infrastructure engineered specifically to support 100 kilowatt GPU rack densities. That is the bleeding edge of what next-generation model training is going to require, and Nebius is building it now, ahead of the demand curve, rather than scrambling to catch up with it. But here is the question that the legacy cloud incumbents absolutely do not want retail investors asking. If the underlying hardware is the same Nvidia GPUs, why would Meta and Microsoft pay a meaningful premium to Nebius rather than simply spinning up workloads on AWS or Azure? The answer comes down to a single architectural decision that legacy providers made a decade ago and cannot easily unwind. Traditional clouds were engineered for the general internet, layered in virtualization stacks, optimized for workload flexibility, and designed to serve millions of different customers simultaneously. All of that virtualization creates tail latency. And in large language model training, if even one GPU in a cluster lags behind even slightly, the entire cluster is forced to wait. Nebius runs InfiniBand bare metal orchestration, thousands of GPUs operating with no virtual layers between them, functioning as a single unified supercluster brain. This architectural superiority is what analysts are calling the margin gap, and it is the precise, technical reason why hyperscalers are willing to sign contracts with 9 zeros on them rather than defaulting to an existing cloud relationship. And the strategic vision extends well beyond GPU training clusters. Nebius just placed a $400 million acquisition bet on Tavily, an Agentic AI search startup, and is now collaborating directly with Nvidia on what they are calling the Physical AI Data Factory Blueprint, a framework purpose-built to accelerate industrial robotics and autonomous systems. When Jensen Huang publicly declares that Agentic AI is the next major technology frontier, Nebius is not sitting back and drafting a roadmap. They are already building the execution layer for autonomous industries. From self-driving vehicle systems to factory floor robotics, Nebius is positioning itself not just as a training compute provider, but as the foundational infrastructure layer for the entire physical AI economy. Could this company quietly become the most important company in AI that most retail investors still cannot name? Now let us get into the numbers, because the financial trajectory here is unlike almost anything else in the infrastructure space. In 2025, Nebius reported a 547% revenue surge, not a typo, 547%, closing the year with $1.14 billion in revenue. Even more significant, as a signal of business model maturity, they posted their first full year of positive net income at $29 million. Management is now guiding for annual recurring revenue of $7 to $9 billion by end of 2026. If they execute against that guidance, we are looking at approximately 13 times revenue growth compressed into just 2 years. When is the last time you saw a legitimate infrastructure company with real contracted backlog print numbers like that? But this is Smart Stock Sam, and we never let a compelling growth narrative bury the risk picture, because the risk here is very real, and every serious investor needs to understand it clearly. The single largest threat to this entire thesis is what analysts are calling the Capex treadmill. To fulfill that $46 billion contracted backlog, Nebius must deploy an estimated $15 billion in new hardware by 2028. Last year alone, free cash flow came in at negative $3.6 billion. They are essentially running a massive infrastructure construction project and asking the public markets to finance it in real time while they wait for the contracted revenue to start converting in 2027. The window between the spending and the receipts is long, it is expensive, and it leaves very little room for execution error. And there is a second layer of risk that every current and prospective shareholder needs to have fully priced in. To fund this build-out without running dry, Nebius launched an at-the-market equity program, allowing them to sell up to 25 million new shares directly into the open market. For existing shareholders, that is dilution sitting right above your position, being used to pay for the next generation of Nvidia hardware. Layer on top of that, the customer concentration exposure. Meta and Microsoft represent the overwhelming majority of contracted revenue. And if either of those two titans accelerates their pivot toward custom in-house silicon, Nebius could find itself sitting on billions of dollars in underutilized hardware with very few alternative buyers of that scale. These are not theoretical tail risks. These are structural realities that the valuation must honestly account for. So, where does Wall Street actually stand on what this company is worth today? The analyst community is sharply divided, and the spread itself tells a story. On the bullish end, Northland has issued a top pick designation with a price target of $232, citing conservative revisions to their 2026 revenue model. D.A. Davidson and BWS Financial both raised their targets to $200 in the immediate aftermath of the Meta announcement. On the other side of the ledger, conventional discounted cash flow models applying standard discount rates to the projected revenue build are producing intrinsic value estimates as low as $94, in scenarios where the blue sky targets are not perfectly met. The gap between $94 and $232 is not a minor disagreement about assumptions. That gap represents the entire argument about whether Nebius is a critical utility or an expensive construction bet with binary execution risk. Before we close, an important reminder: nothing on Smart Stock Sam is financial advice. Everything you hear on this channel is strictly for educational and informational purposes only. Always conduct your own independent research, consult a licensed financial advisor before making any investment decisions, and never allocate capital you cannot afford to lose. The AI infrastructure space is moving at extraordinary speed. Valuations are aggressive across the board, and position sizing relative to your individual risk tolerance is not optional. It is the whole game. Here is where we land on Nebius. This company has crossed a threshold. It is no longer a speculative recovery story about a firm reinventing itself out of geopolitical wreckage. It has become something structurally different, a load-bearing pillar of the physical AI economy, underwritten by Meta, validated by Microsoft, equipped with priority silicon access through Nvidia, and executing a gigawatt build-out that very few organizations on Earth could finance. The contracted backlog is real. The silicon access is real. The architectural edge is real, and the execution risk is equally real. For investors who understand the volatility profile of a capital-intensive arms race and can hold through it, Nebius remains one of the most leveraged pure-play positions available on the physical backbone of the AI era. The model has been proven beyond reasonable doubt. the chapter that begins now is entirely about execution. If this breakdown added value, hit the like button, subscribe so you catch everything we cover next, and drop a comment below telling me whether you are sitting in the bull camp, the bear camp, or somewhere in the middle. I want to hear your thesis. I will see you in the next one.